Now that the Reserve Bank has chosen to slow the rate of interest rate rises, and with maybe only one or two more interest rate rises to come, and with the fact that inflation is likely to peak in the foreseeable future, does this mean that property values might find their floor sooner rather than later? Now, while we're not in positive territory yet, the latest data provides some speculation that our property markets may turn early next year. So in today's Property Insider Chat, Dr. Andrew Wilson and I discuss that, plus we talk about the latest finance figures, housing approval, auction clearance results, and things that you need to understand if you're interested in property. So if you want to keep up with the latest in property, please subscribe to our YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Having delivered a shock and awe campaign of massive interest rate hikes since May, the Reserve Bank of Australia chose to slow the pace of policy tightening at its October board meeting. Now, that's despite robust retail sales and a tight labour market. But Reserve Bank Governor Philip Lowe wants to watch. He wants to wait for more information on consumer spending, on inflation and on wages. So does this mean Australia's housing correction may not be as bad as originally feared by many people? It seems to me that many buyers are taking interest rate rises in their stride after that initial shock of the Reserve Bank's first double rate rise starting in May. Now, we're not in positive territory yet, but the latest data provides speculation that we might move back into positive territory early next year in our property markets, especially with inflation forecast to peak in coming months and only one or two more interest rate rises on the horizon. So what's ahead for interest rates in our property markets? That's what I discussed today with Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing economist, in this week's Property Insider Chat. Hi, Andrew.
Yes, good day, Michael. And it's been a big week for property news, starting with that price data that was released for September. Even though prices were still falling in Melbourne and Sydney particularly, certainly the rate of decline, and that's something we've been promoting over the last month or so prior to those figures coming out, that the rate of decline is now easing. And of course, it's got to start somewhere. You just don't go from sharply falling prices to rising prices. It is about the easing of the rate of growth to begin with, and we're certainly seeing signs of that now. And as we've discussed, that is being correlated by other data sets such as days on market and auction clearance rates that are confirming that our housing markets are certainly performing a lot better coming out of winter than many expected. And I think we'll start to see some significant revisions of some of those predictions of house price crashes, but we shouldn't be surprised at that, shouldn't we? But as you said, Michael, it was the week did start off with the Reserve Bank's decision on interest rates. It was a shock, I would suggest, to most that they didn't go with the usual 0.5% increase, which has been the standard over recent months. In fact, I think there was only one forecaster that went with the 0.25% increase, and that was the Commonwealth Bank. Certainly, it was a very positive sign for the prospects for the housing market, A, and for the economy, B, that our interest rate rise was half of what it's been over recent months. And I think all power to the Reserve Bank in a sense, because we're still seeing upward pressure on interest rate increases in terms of the actual rate of increase in other overseas economies such as the UK and the US. Perhaps the Reserve Bank has decided it's not going to throw out the baby with the bathwater, if I could say that, by crunching the economy to try to control inflation. And Australians generally just seem to be getting on with business, Michael. And maybe that's part of what's drove that decision last week from the Reserve Bank, that we're not seeing any real signs of stress, and maybe some of those inflation drivers are starting to moderate. But there are some signs that we may be getting a rebound in some of the inflationary factors, such as the price of oil and house building costs, which are now showing some signs of rebounding over the past month. And of course, they're significant contributors to inflation.
Well, the Reserve Bank Governor's taken, I guess, at least one foot off the economic brake. He's wanting to assess how his aggressive policy tightening is taking effect. He's going to watch what's happening to retail spending, inflation, and wages. Now, as you correctly said, there was only one bank that predicted a 0.25% interest rate rise, and they're suggesting that there's only going to be one more interest rate rise this cycle. The other banks are suggesting that there's going to be 2 more interest rate rises, but we're not going to get to the heady high interest rates that could crash the housing markets and the economy that some of the naysayers were suggesting only 6 months ago.
Yes, I'm a bit surprised. I'm not sure we'll get just one more, Michael. It's certainly, the outlook depends on the data coming through, as you said. But I think that's obviously a pleasant outlook that the economy only needs one more interest rate increase, and that would leave us at around about, well, certainly under 3%, I think, Michael, in terms of where we land, below or at 3%. And I think that's, given the historical level of official interest rates, that's still well below where the averages have been. So I think that was very positive news. And if we only end up getting one more increase, I think we can all be pretty satisfied with that, particularly given that overseas economies are still struggling with their inflationary outbreaks. And as we've discussed previously, Michael, their inflation rates are well ahead of Australia's. And I think part of what's keeping us under control is actually our wages aren't out of control at this stage either, there are signs of that in the US and the UK. And I think that's driving their inflation higher. But the latest data out of the US last week, Michael, was the jobs report. And that certainly was again sobering for the Fed in the US, because it was actually quite reasonable numbers. And there's no significant sign anyway that interest rate rises in the US have had the sort of impact I would thought that the Fed would be looking for. Jobs are still being created at quite a robust rate. Wages are rising. And of course, that's going to pave the way for, again, higher inflation, because the US has more of a prices, wages chase happening, which is what, of course, we all want to avoid to control inflation. But I guess the other problem I alluded to before, Michael, is that we've seen OPEC and Russia do a deal on the supply of oil. In fact, they're going to reduce the production of oil significantly. And unfortunately, that's not what we want to hear, because that'll only put up the pressure on oil prices. And that's a negative in terms, again, of the outlook for the US. But it is interesting that we seem to be detaching ourselves to some degree, this stage anyway, from what's happening in similar overseas economies.
Well, when we look at our housing market, all these factors affect consumer sentiment, which is one of the reasons our housing markets have been quiet this year. But it looks like the correction may not be as bad as some feared. Many buyers seem to be taking rising interest rates in their stride. I mean, they initially got a shock in May when interest rates went up, and then went up 0.5% and went up a few times. But with inflation likely to peak in the coming months, whether it's late this year, early next year, and with interest rate rises again also likely to peak, even if there's a couple more, they won't get as high as some expected. Seems like people are now just accepting it and moving forward with their property decisions, Andrew.
Yeah, I think we're sort of moving out of that phobia environment, fear of being involved, which was generated, of course, by a lot of negativity regarding the outlook for interest rates. And of course, it was the winter market anyway. And of course, we're coming off the back end of a remarkable boom in activity and prices. So there was always, the end game was a pause in activity as affordability drove buyers out of the market. So it's been a sort of a confluence of a winter of discontent, but really, it hasn't been that bad, to be quite honest, when we look at the historical comparisons. And September's been a very solid month. And we mentioned that before about the correlation of more positive factors for housing market activity over the past month. And this weekend was, maybe that less than expected increase in interest rates worked its way into the results for the auction markets, because we've had some, again, strong results, well, relatively strong results. Let's not get too carried away regarding auction markets in Sydney and Melbourne. And I think maybe that's we're starting to see just the sense that confidence is building in our housing markets, Michael, particularly the markets that led the charge downwards, and that was Sydney and Melbourne.
Yes, Andrew, this weekend, the capital city auction markets seemed to rise. Clearly, it was strengthened by the two big markets, the Melbourne and Sydney markets, which delivered some good results.
Yes, the Sydney market bounced back and the Canberra market bounced back with auction listing numbers from the previous weekend's pause due to the Labor Day long weekend holiday. Clearance rates last weekend were a little lower in those capitals because of the distractions of long weekend. No, so certainly the Sydney market and the Canberra market were both back with a vengeance on the weekend. In fact, Sydney's clearance rate was above 65%, we always discuss, Michael, I guess, consider that around 65% is the neutral zone for our auction markets, auction clearance rates. Once they start moving above 65%, start to create a bit more competition amongst buyers for property, and we start to see prices starting to neutralise and rise once we start rising consistently above 65%. Well, both Sydney and Melbourne were above 65% at the weekend, Michael. That's the highest result for Melbourne since May. With that surge in listings, I think it reflected in Sydney the appetite for buyers for property. Melbourne listing numbers were a little lower at the weekend. I think there's still some school holiday energy happening there. When we look at the prestige markets, the higher priced markets in Melbourne, there was stock numbers are still not where they will likely be over the next few weeks as the spring market matures. But certainly these results, and it's not just 1 week of results, Michael, we're clearly seeing the trend now rising over the past month to 6 weeks. I think these are very positive results from our auction markets, and it's not coming from low listing numbers either. Sellers are obviously quite happy to engage the market at the moment, and I think we'll see higher numbers of auction listings coming through over the next month, as we typically do see as the season develops. But yeah, look, I think, again, very positive news, maybe driven by reinforcement of rising confidence from those the RBA's decision during the week. But let's be clear, Michael, with such a strong economy, and it's a booming economy in the jobs market, we've never had really unemployment rates this low. Wages are rising. There's so many stories everywhere about people getting these great pay increases, and being chased by employers everywhere to come and work for them. So I think that, helps people think, well, I'm doing pretty well here. I've got a great job and I've got an increase to significantly higher income, so I'm going to get on with life. And that means being in the property market and taking advantage of what are lower prices at the moment. I think the prospects continue to unfold in a positive manner on all the key indicators, particularly those weekly auction results are certainly heading higher and beyond the neutral zone, perhaps over the next month or so. And that would be quite remarkable. And I think the one thing about our auction results since we've had our interest rate rises and the impact it had on confidence and affordability, particularly July and August, was that when we compare it with a similar period back in 2018, when confidence was fragile, there was a lot of quite loopy predictions of house price crashes as usual. Maybe we're just getting a bit sick and tired of that. But we had auction clearance rates hovering in the 40s at that stage. And the market, the trend auction clearance rates are well ahead in Sydney and Melbourne compared to where they were at the same period in 2018. And I think that tells a pretty clear story in comparison why this isn't just going to be some sort of a repeat of what happened then, but the markets are just shrugging off their issues and getting on with business. And as I said, I think the strong economy is the key here.
Well, one of the other factors, of course, is that there's a shortage of properties in general, and that's unlikely to change in the immediate future. In fact, for quite some time, we keep a careful track of dwelling approvals because that gives us an indication of what's ahead. But they've been very volatile over the last couple of months, Andrew, up and down. This month, they're up considerably, but it's related to the large swings in the large apartment complex approvals.
Yes, and we've had some interesting results with building approvals this year, Michael, particularly in Melbourne, where we've seen a surge in apartment development over the first half of this year. But of course, as you said, Michael, the apartment market data tends to be lumpy because you can have a very strong month because of a strong or a large development or a number of large developments, which obviously push the numbers up, and then the following month you don't have that same energy and numbers fall again. I think the house building has been, it's holding its own approvals for new houses, Michael. It's certainly flattened out after last year's boom. There's some signs there that that's just finding a reasonable level. We're well down on the total dwelling approvals that we had at our peak back in 2016, Michael. We are still clearly undersupplied, and we're going to need a lot more, particularly apartments across the board, to satisfy that underlying demand going forward, particularly now that we've clearly seen signs that we're up and running in terms of migration. Not just permanent migrants, but also student numbers are rising quite strongly, international student numbers. And of course, that's part of what's driving higher rents in our rental markets, particularly for unit.
Now, just because there have been approvals granted doesn't mean that
That's right.
apartment towers are going to be built. They've actually got to be financially viable, and currently with the higher building costs and the depressed property values, many of those won't get out of the ground for some time, Andrew.
No, that's right, Michael. And a little disturbing was that the latest building index data from my housing market has shown a reversal of the trend that we've had running over the past 3 months, which was a decline in the annual rate of house building costs. That actually bounced back over August, and that was the first annual rise in house building costs that we've had for 4 months.
Another forward indicator we keep an eye on is home loan approvals, and they fell in the month of August. Sure, that was only released last week in October, but it gives us an idea of how many people are getting approvals and looking at getting in the property market, Andrew.
It's just another, I guess, correlating factor. We know that August was a quieter month, and I guess that just reinforces what was happening in August, and it is a backward-looking data set. But again, just reinforcing that was the trough of our market to a large degree. And I think we've suggested that August may be the trough of this current downturn.
One of the interesting factors, not surprising though, was that the percentage of fixed rate mortgages has fallen to just 4.4% of new loans taken out from its peak of 46% of new loans July last year. But with what's happened to interest rates, that's not a surprise, is it?
No, Michael, that's true. And I think the other point is also that we're still seeing a lot of energy on refinancing. And I think that's because people are spooked regarding the outlook for interest rates, but we may start to see the level of refinancing easing now with these much more optimistic outlook in terms of where interest rates are going. And perhaps those that fix their rates will be a little nervous about having to refinance next year or the year after.
The Reserve Bank recently reported its financial stability report, suggesting that even if interest rates do go up, the average household in Australia is going to be able to handle it. Because if you remember, it's only about a third of households that have got a mortgage, Andrew. A third rent, a third of half of homeowners don't even have a mortgage.
Yes.
It'll be interesting to unpack that financial stability report when we catch up next week. Look forward to having a chat again then.
Thanks, Michael.